So we go to the next one, which is input tax credit. Last demand situation now.
Section 16(1) states that every registered taxable person shall, subject to such conditions and restrictions as may be prescribed, and within the time and the manner specified in Section 35, be entitled to take credit of input tax admissible to him, and the said amount shall be credited to the electronic credit ledger of the said person. Section 257 defines that input tax in relation to a taxable person means the IGST and the CGST or IGST and SGST charged on any supply of goods and or services to him which are used or are intended to be used in the course or furtherance of his business and includes the tax payable under subsection 3 of section 7.
Okay. So basically, if you look at this broadly, we are saying input tax credit will be available. We have a concept of electronic credit ledger. So it's like in the older days we had a MODVAT register, which we now say SENVAT register, and RG23A is the loose acronym which we used to use. Same way there is a ledger, wherein all the input credits will be dumped. It's a ledger. It's not like your current VAT practice that every month your liability is a net liability. It's not that. It's like your SENVAT mechanism today. You will have a balance. You will have an account wherein all the input tax credit will be dumped, and you can choose to use some part of it or full of it for payment of your output taxes. And balance amount will be carried forward till eternity. There are refunds only in case of exports or what prohibit you are in a inverted rate structure, meaning your output tax is 10% and input tax is 20%. So those two cases there is a refund mechanism. Except these two cases, there is no proposition to grant you any refund of any nature whatsoever. So that is important to keep in mind that it's an electronic credit ledger. So ledger we understood. The larger concern is the electronic side of it. In a way it's good, but in a way it's a complication. The whole idea is your entire credits will work only through a concept of GST network. There is a GST network. It's a Section 25 company which has been created, and that company has awarded a contract of developing a portal to Infosys. Infosys is on the job of developing it. I understand it's 70 to 80% ready. The process flow, the forms, all of that is available in public domain, and there's a detailed process which I'll take you through in the next couple of slides. But suffice it to say, like your 26As, 10 years ago you claim credit based on a physical TDS certificate. But today if you have to claim a credit, you have to make sure that your 26As has the tax credit. If it does not have the tax credit, your officer is not going to give you any credit whatsoever. Same concept will apply here. There is an input tax credit ledger under electronic format in the GST portal. If the credits don't flow into that, you will not be given the credits. You might have genuinely purchased the goods, you might have genuinely purchased from a registered dealer, you might have a proper tax invoice, you might have paid tax on our food. It is not, he will have just one answer, it is not reflecting in your GSTR return. That's all.
Every month we have to see that electronic.
Yeah, so there are dates, and when you see those dates, I think people will faint. At least I fainted when I read it for the first time. I'll come to that a couple of slides down the line. So this is the concept. So it's heavily dependent on a network. It's heavily dependent on a network, and that to some extent is a complication. Of course, the section 257 defines input tax, and when you read this definition, it still requires a usage, a nexus. It's not only network which will create the credit. Your credit eligibility is still dependent on nexus. It is still dependent on use. Only saving grace is, it is wider than the current one. Currently we say input service means any service used for providing an output service. So the nexus has to be with an output service or a supply. Here we are told used in the course or furtherance of business. So it is wider as compared to the current definition of input service. So in that sense it's positive step as far as this section is concerned. So used nexus theory we discussed. Of course there are provisions which say that if you are using for a personal use, for most of us here are corporates, it does not apply to a large extent. But if it's a proprietary concern and he uses a motor car for personal purposes, income tax says that 1/3 of depreciation I will not allow, and some motor car expenses I will not allow. So those type of handles the GST officers will also have in future. So if there is a use which is for personal purposes, credits will not be allowed to that extent. Of course, if you have a mixed outward supply, so if let's say you have some products which are taxable and something which is nil rate is also an exempted outward supply, then you will have a proportionality coming in. Like today you have rule 6.3. They will not frame the rule, they said we will frame rules, but something like that you will have if you have a taxable income as well as a non-GST taxable income. So that is where you will have to highlight that as well. Now, in the starting I highlighted that there are 3 taxes. And it's important to understand which can be adjusted against all. So like today we have service tax and KKC. SBC को credit ही नहीं है. Service tax and KKC. Service tax only against service tax, KKC only against KKC. KKC can't be adjusted against service tax can't be adjusted against KKC. So here we have 3 words. We have CGST, we have SGST, we have IGST. And please note you have these 3 words across 30 states if you are registered in 30 states. So for each state, how will you adjust? There are rules which they have given. All of this is codified in the model law, so we'll try to talk about it. So these are your inwards, so input tax credit ledgers. So you have a CGST input tax credit, IGST and SGST. And you have an outward supply which is shown in these saucers. So you have a CGST output, IGST output and SGST output. And they have given rules of preference. The first rule of preference is like against like. So all your CGST input credit first adjust against the CGST output of that state. This is a state specific, please note. CGST of Bombay cannot be adjusted against the CGST of Calcutta. It is state specific. Same way IGST against IGST, SGST against SGST. That is the first rule of priority. Am I clear up here?
So Maharashtra, student Maharashtra input.
Yes. So you will have 30 slides like this if you have 30 slides. And then to connect them you have a concept of ISD which I will come to. Okay, is this first rule clear? Second rule is C against I against C. You have to go in this order only. You can't change the order. C against I against C. Third rule is I against S against I. Okay, so 3 rules of priority. Like to like, then C against I against C, and then I against S against I. Are you clear up here? C cannot be adjusted against S cannot be adjusted against C at all. Okay, so these are the 4 priority rules which we have to keep in mind. And then that's where your procurement, marketing, all those things we have to care of. We'll have to look at the place of supply rules, look at our locations, look at our procurement patterns, and then estimate where are we likely to have more C's and S's and things, because I is acting as a bridge. So wherever you find that you have a state where there's a lot of S input and not enough S output, maybe you can use I to interpolate it. So that is where micromanagement and planning, at least for some time, will be required. You will have to realign your marketing and procurement strategies if you are a multi-location. If you are in one state, life is simple. But if you are multi-locational, and I am sure a lot of us are, then there is a problem. So this we talked about.
So
Then yeah.
how the TCS going to be adjusted?
How?
TCS, tax collected at source.
Yeah, TCS again will go into 3 compartments.
So there are also CGST and IGST and
Yes.
there is also deposit.
CNS. Both the laws will happen. So timelines, again, that's not enough. We have timelines, we are told you have to claim the credit within 1 year of the date of tax invoice, and there is an annual filing of return. So by 30th September, you have to make sure that all rectifications in this relation are done before that period, because they have a period to period matching concept. So you need to make sure that you make all the necessary amendments by the September of the next year.
Sir, but because timing is 1 year.
Yes.
So the voice for taking the paid 16, we can take paid September 18 also.
No, September 16, you are April 16 credit, you have to, April 16 is of course old law, April 17 is a credit. That you can claim up to April 18. That's all.
Now, suppose the bill suppose April, as per subsequent period, up to next year, 30 September. 1.5 years.
So what happens is, you have to do the revision by that period. Okay, so your credit has to be claimed within 1 year, but it is still restricting into September. So April will not be a problem. You have to claim within April of the next year. But if it's a November invoice You have to claim before September. You can't wait till November because they have to close their financials. March invoice and up to September. Because the financial year ends, no? And that's why they want to close their entire thing.
So basically, as of September, whatever is short claim is carried forward. Technically.
If you have claimed, it will be carried forward. But if you have not claimed, that's a concern.
If I have not claimed, then only I am going to. The input credits which I have not claimed, I am going to carry forward.
That the input credit which you have not claimed, you can claim it only up to September. There's a difference between claimed and carry forward. Carry forward comes after claim. So like in currently SNVID you have availed and utilized. Same way you have claimed and carried forward. Claimed and utilized.
So claimed in September and carried forward.
Carried forward. But if you not claimed, you can't carry it forward. And claiming के लिए ये time limit है. 9 months. And March invoice 6 months.
From the date of receipt of invoice you mentioned.
Yeah, but see, you have two rules. And when you have two rules, both of them have to be interpreted. So generally 1 year. So April ka invoice you can't take it to the next September. You have to take it within 1 year. But October ka invoice by the next September.
But if in current scenario, like service tax,
Yeah.
anything until even invoice is in March 16.
You are able to do it March 17, but that will not happen. So that is where your procurement plans will have to be. It's going to be a challenge, and this is not the only one. I will get a few more challenges as we move ahead into the returns part. So it's going to be a tough game to make sure that all your activities are done within the timelines which are prescribed.
You will have to write off that credit. Write off the credit.
So 1st October plus 1 year. No, so the flow happens in the next year. So there is a provision for all of that. There are specific sections which talk about advances getting adjusted at a particular point of time. So what happens is supplier gets the advance, he pays GST on that day. But your entitlement for credit starts only when you receive the goods. So let's say you receive the goods in April, or you receive the goods in October. So after that, 1 year is the time frame, subject to this 30th September. And all the returns also have those provisions. There's a separate section for putting advances, and from there there's an allocation which has to be done. It's a complex game. All the GL concepts they have tried to bring.
Sir, again, utilization there is no restriction.
Utilization there's no restriction, but the first claim there's a restriction. So that is as far as the timelines is concerned. Ineligibility of credits. Some of the currently ineligible credits continue. Motor vehicles will not be eligible unless they are used for those specific businesses. Same thing like what we have. If your vendors are composition dealers, small dealers, and they are being taxed under composition, credits will not be available. Also, goods or services used for personal consumption of employees. All the current exemption of exclusions like canteen supplies, club memberships, or Mediclaim, which is not currently available as credit, all of that continues in the future. And construction of immobile property is again a negative list item, other than plant and machinery. So these are the negative list items. All these credits are not available to you. Next was to output which is there, so I'll just skip. For a lot of time, we just skip. Let's look at the documentation side, and that is important. If this much is not enough, there are more conditions. If you want to claim the credit, it's not important that it goes only in your electronic ledger. You should also have a tax invoice with you. Without a tax invoice, you can't claim the credit. You should receive the goods and or services. So this is where the advance concept comes in. If you have just paid in advance, you can't claim the credit. You have to actually receive the goods and or services. The third one is a little bit of a tricky point which they have borrowed from VAT. They say that tax charged in respect of such supply has been actually paid to the credit of the appropriate government. Which means if the vendor defaults in his tax liability, your credit is evaporated. You do not get the credit. Which is happening in most of the states in VAT as of now. But service tax we don't have such a provision. Service tax we say I have a valid tax invoice, the vendor is registered, so I have to get the credit, you go and change the service provider. That goes away. Moving forward, it is your responsibility to ensure vendor compliance.
But the good thing is
correct ledger which you can kind of.
Yes, you can find out fast, but then it's still an aspect of chasing. One more interesting aspect is, in the list of offenses and prosecutions which I talked about, there is a situation where, and again this they have imported from customs and they have customized it for services. So in customs today we have a situation that if an importer smuggles goods and he sells to you, you are also a defaulter. A buyer of smuggled goods is equally at fault. They have just substituted the word goods with services. So they have said, if any service provider provides a service in contravention of any of the law, GST law, the service receiver will also be at a fault. And there is a prosecution of 3 years for it. So that is all the more a reason for appropriate vendor due diligence and vendor compliance. It's an important aspect which we will have to make a part of our organizational DNA. Without that, GST is going to spring up many surprises for us in the future. So that is that. And finally, you should have furnished a return, which is fine. So these are the conditions and documentation. So we have a tax invoice which will have some information, something similar to what we have right now. So I don't go into that in detail. This I think we should do, credit notes and debit notes. You answer.
Section 24(1), where a tax invoice has been issued for supply of any goods and or services, and the taxable value and or tax charge in that tax invoice is found to exceed the taxable value and or tax payable in respect of such supply, the taxable person who has supplied such goods and or services may issue to the recipient or credit note containing such particulars as may be prescribed on or before the 30th day of September following the end of the financial year in which such supply was made, or the date of filing of the relevant annual return, whichever is earlier, provided that no credit note shall be issued by the said person if the incidence of tax and interest of such supply has been passed by him to any other person.
So this is something similar to your Rule 63 of the service tax rules. Wherever there is a reduction in value or an increase in the value, you can issue a credit note or a debit note and accordingly claim an adjustment to the original GST supply. But if you read it in micro detail, you will find that it talks about a variation in the value. It does not envisage a situation of goods rejection. So when your value itself exhausts to zero, let's say you have supplied goods and the vendor and the customer just returns the goods back to you. There is no provision dealing with it. And a likely reason, yes.
Situation is that if supplies happen and conversion taking after 7 or 8 months later, then the rejection comes later. Maybe.
Yeah. So it can be similar at the same time or maybe few months down the line. Today, like for example, VAT laws allow 6 months time frame, within which goods rejections are allowed as an adjustment from the VAT payable. And that exactly is the point which I am hinting at, that perhaps there is no such provision of that nature. The thought process is something like this, that when the customer rejects the goods, it is an independent supply by the customer to you, and he should charge you output GST, which you should claim as credit.
So it's in form of a debit note.
Yes. So he will issue an invoice or a debit note and treat it as his outward supply and charge you GST. So you claim input GST credit of that GST and not an adjustment in your output GST. Now it's easy said than done.
But what would be the value?
Same value. Yes, but excise is a limited field. Here we are having a much wider field, and when you have this type of a provision, sometimes it can become a problem. And some hint for this we can get from transition provisions also, wherein they have said that if you are supplied in the pre-GST regime and the rejection happens within 6 months, we will not deem that to be a separate supply. So that concession has been given for transition, and that by itself would explain that yes, the law does not envisage a GR situation. The law envisages a credit note debit note situation only for adjustments of value, not for rejections. So that is an important aspect which I thought we should just discuss. Now of course this is credit, and so then it's not a supply. So again this is one area wherein we'll have to see how it looks, because when there is no supply at all, how will you deal with this situation? They are not addressed. Because what happens, there can be various situations. One is like, as you said, the goods are in transit and they get damaged. Second situation is you received advance, you paid the GST, and then the transaction just fails. Just fails, it does not happen. He says you can refund the advance, the transaction is not happening. Now, there's no section in the law talking about this. Like Rule 63 today talks about non-provision of service or deficiency in service. Here there is no such specific clause used. Secondly, even when you go to the format of the returns, which we'll come to in a few minutes, there is no mechanism to cancel this type of transactions. So it will have to be a rectification. There is a mechanism to rectify a return. Now we'll have to actually see when they bring out that prototype in the public domain, whether the rectification will allow deletion of an entry which is already made, or will it allow only change in the amounts or the TIN numbers. So that is something which is a little bit of a hazy picture as of now. So, yeah.
One more question.
Sure.
Whether there is any precondition of value addition? Actually,
No.
very high tax.
Yes, here there is no such precondition. Even if it is sold at a loss, you will be eligible for full input tax credit. But only make sure that the valuation rules, there is authority to him to show cause why your value should be rejected. That is the only concern which you might have in your mind. Now coming to the last, we said that the C, I and S baskets which I sold, I said that it applies across 30 states and each of them is a separate slide in itself. And that's where the concern comes that if I am a head office, I might have lots of input services at my end and there is no output, and their outputs are at the 29 other branches. So they have borrowed the concept of ISD from the current service tax law. They say that you can register the unit as an ISD and then transfer the credit only in a proportionate manner to the turnover of each of the receiving units. So something similar to what we have right now, monthly turnover. Same way they have said that based on the turnover criteria, you can transfer the credits of C and I as IGST. SGST credits cannot be transferred, and logically so, because SGST credits belong to that state and you can't push it to another state. C and I, both of them will be transferred as IGST credit to the receiving state, only in the case of input services and only to the extent of the turnover attributable to that state. You can't arbitrarily choose and say that look, X unit has a lot of output tax, so I transfer it to X and not transfer to Y. It will have to be in a ratio. So that is as far as ISD is concerned. So you can transfer it, for example, in this manner. This is what we talked about earlier. And then we have specific rules for removal of capital goods. Maybe you can just quickly review.
Reversal of removal of capital goods, section 1614. In case of supply of capital goods on which input tax credit has been taken, the registered taxable person shall pay an amount equal to input tax credit taken on the said capital goods reduced by the percentage point as may be specified in this behalf for the tax on the transaction value of such capital goods under subsection 1 of section 50, whichever is higher.
You have picked it up verbatim from the segment credit rules. This is there today also. Only concern is, today when I sell capital goods, I don't need to pay excise. Moving forward, there is a CGST on sale. So, if I am anyways paying CGST and SGST on my transaction value as my outward supply. Over and above that, I will be required to reverse the corresponding input credit on a depreciated value. So, it's a double whammy. All of these concepts are required because you are a tax on manufacture. The moment you bring a tax on supply, which is much wider, you don't need these. You are duplicating the tax. You are duplicating the impact of the tax. Job work, of course, we have 180-day criteria. So, registration, of course, only credit is available to a registered taxable person, and that's also one of the reasons why you should register in time.